You want to know what really makes me laugh? Not the jokes, not the obituaries, the press releases. Every quarter, the largest companies on earth stand in front of their investors and repeat the same three words: transformative AI investment. And every quarter, the same investors, grown adults, some of them with PhDs, nod along and bid the stock higher. I'm Charlie Munger. I've watched financial markets for over 70 years. And what I'm watching right now is history rhyming. Not loosely, not approximately, perfectly. In the year 2000, I watched the most valuable company on earth lose 86% of its value in 12 months, and it took that company nearly 2 decades to recover. The company was Cisco Systems. The narrative was perfect. It doesn't matter which website wins. They all need Cisco's routers. Today's version of that sentence goes, it doesn't matter which AI model wins, they all need NVIDIA's chips. Different decade, different technology, identical logic, identical danger. Now, before we spend the next hour together, let me say something that I think the purely bearish commentary almost always gets wrong. I am not here to tell you artificial intelligence is a fraud. It is not. I'm not here to tell you the companies building it are incompetent. They're not. The internet was real, email is real, e-commerce is real, Amazon is real. None of that stopped Cisco from destroying its shareholders for 2 decades. A great technology and a great investment are not the same thing. They are not even closely related. Confusing them is what I call a category error, and it is one of the most expensive mistakes that investors, generation after generation, keep making. Today, I'm going to show you the math that the venture capitalists and the Wall Street analysts are actively choosing not to run. I'm going to show you why the AI revolution, as currently priced, is on a collision course with something that cannot be negotiated with or lobbied against. I call it the physics of reality, and I'm going to give you 3 filters, a checklist, that will help you decide clearly and without emotion which companies survive the reset and which ones end up as the cautionary tales people quote at cocktail parties 20 years from now. Let's begin. Coming up, the plumbing analogy that has destroyed more investor wealth than any other idea in technology history, and why it's back. Let's go back to 1999, Cisco Systems. You may remember it, or you may only know it as that stock your parents still hold at a loss in their retirement account. At its peak in March 2000, Cisco briefly became one of the most valuable companies in American business history, a market capitalization approaching $700 billion. Its forward price-to-earnings ratio exceeded 130 times. The narrative was flawless. Cisco made the routers, the literal plumbing through which all internet traffic flowed. Every startup, every e-commerce company, every bank going digital needed their equipment. Quote, "It doesn't matter who wins the internet race. The plumber always gets paid." The logic was seductive. It was also catastrophically wrong. Here is what the bulls missed. I call it the physics of saturation. Once you lay the fiber optic cable, you don't need to lay it again for a very long time. Once the routers are installed, you don't need new routers every quarter. There is a build phase, and then there is a use phase. And in the use phase, the company that sold you the infrastructure becomes dramatically less essential. Cisco fell 86% from its peak. It did not recover to its all-time high for the better part of 2 decades. Now hear this clearly. Cisco was a real company, real revenue, real customers, real technology. None of that protected its shareholders. Now in 2026, I want you to notice something. Microsoft, Meta, Google, and Amazon have together committed to spending somewhere in the range of $600 to $650 billion on AI infrastructure this year alone. They are building, in the words of one of their own executives, cathedrals of silicon. NVIDIA supplies the most critical component of those cathedrals. Its chips power the training and inference of nearly every serious AI system on Earth. And the narrative, again, is flawless. It doesn't matter which AI model wins, they all need the chips. Now, here is where I insist on intellectual honesty, because honesty is what separates analysis from propaganda. NVIDIA in early 2025 was trading at roughly 40 times forward earnings. Cisco at its peak was at 130 times. That difference matters. NVIDIA also has genuinely superior margins to anything Cisco ever achieved. So I'm not making the lazy claim that history is literally repeating. That would be too easy, and it would be wrong. I'm making the more important, more dangerous claim. The structural dynamic is the same. An infrastructure company whose customers are in a build phase will always look extraordinary. The question every investor needs to be asking, and almost none are, is what happens when the build phase ends. And in 2026, we are approaching that inflection point. The hyperscalers are not building these data centers out of charity. They are building them under a set of return on capital assumptions. When those assumptions get stress tested by the arithmetic, and I will show you the arithmetic in the next chapter, the build phase does not just slow, it reverses. And when it reverses, the plumber's phone stops ringing. Next, the number that nobody in Silicon Valley will put on a slide deck. $600 billion spent. How much earned? The answer will make you uncomfortable. I've always said, if you cannot do the math, you have no business being in the game. So let's do the math. Look at the screen for a moment. Let that number sit in your eyes. The technology industry is committing capital to AI at a pace with no precedent in modern business history. The consensus estimate for 2026 is between $600 and $650 billion in AI-related capital expenditure across the major hyperscalers. Here is the arithmetic, not the narrative, the arithmetic. If a board of directors approves $200 billion in AI infrastructure spending for a single year, the first question any rational director should ask is, what is the return on this capital? A reasonable cost of capital in 2026, given current interest rates and market risk premiums, is roughly 15%. That is actually generous. I will use it anyway. 15% of $200 billion is $30 billion. That is the minimum profit, not revenue, not gross margin, profit, that this investment must generate in year one simply to justify its own cost. Now, if you assume an operating margin of 30%, which is quite high, you need $100 billion in new, incremental, AI-driven revenue every single year. To put that in context, $100 billion in new annual revenue is roughly equivalent to adding the entire GDP of a mid-sized European economy to your top line every year. From products that did not exist 3 years ago. Where is it coming from? Coding assistants for software developers? Microsoft Copilot licenses for office workers who still can't find the attachment they saved last Tuesday? AI-generated marketing copy that the compliance department then rewrites by hand? These are real revenue streams. I want to be clear about that. They are not imaginary. The question is scale. The question is whether they reach the required magnitude on the required timeline in an environment where capital is no longer free. And the honest answer, which you will not hear from the analysts who cover NVIDIA, is that the gap between what is being spent and what can be pointed to as demonstrable AI-generated profit is not a rounding error. It is a structural mismatch that the current market has simply decided to price as if it will resolve itself. I have seen this film before. The title changes. The plot does not. The premise is always, the returns are coming. They are just around the corner. Give it another 18 months? Sometimes that is true. The internet did eventually produce the returns, but it did so over a decade, not a quarter, and it wiped out the majority of the companies that had been priced as if the returns were imminent. Now here is something that most analyses miss. The misallocation is not driven by stupidity. It is driven by incentives. I have a saying I use constantly. Show me the incentive, and I will show you the outcome. The incentive for a Fortune 500 CEO in 2026 is to say the word AI on every earnings call, because every time they do, their stock-based compensation becomes more valuable. The incentive is not to say, we spent $200 billion and we can point to $40 billion in verified new revenue. That sentence does not help the stock price. So the incentive is to spend, to announce, and to let the market assume the returns will follow. This is not fraud. This is human nature, operating precisely as it always does when capital is available and narrative is rewarded. The correction does not come when someone is caught lying. It comes when the arithmetic can no longer be ignored. That moment, in my judgment, is getting close. And it's not just the ROI gap. In the next chapter, I want to show you why 2026 is structurally more dangerous than 2000. The debt, the rates, the compounding of forces. This is where it gets genuinely uncomfortable. I have a mental model I call the Lollapalooza Effect. It describes what happens when multiple independent forces all point in the same direction simultaneously. The result is not additive, it is multiplicative. Things don't get a little worse. They get dramatically, catastrophically worse, faster than anyone modeled, faster than anyone prepared for. In 2026, we have a Lollapalooza assembling in the background of every AI investment thesis. Let me walk you through the components. Force 1, the debt. In the year 2000, the United States national debt stood at approximately $5.6 trillion. Today, it stands at roughly $37 trillion. That is not a percentage change. That is a different country. Debt at this scale has consequences that are not immediately visible, but are always eventually felt. It constrains fiscal flexibility. It creates a structural floor under interest rates that cannot be wished away at a policy meeting. And it means that any sustained period of elevated borrowing costs carries consequences of a magnitude that simply did not exist in the previous cycle. Force 2, the cost of capital. For 15 years, roughly from 2008 to 2022, the world played a game I would describe as easy mode. The Federal Reserve and other central banks held rates near zero. Money was effectively free. When money is free, the discount rate you apply to future cash flows approaches zero. When the discount rate approaches zero, even implausible future cash flows look valuable today. You can justify almost any valuation if you make the denominator in your model small enough. I'll say that in plain language, without a formula on a chalkboard, because I believe in plain language. A company is worth what it will earn in the future, discounted back to the present by a rate that reflects risk. When that rate is near zero, future earnings look almost as good as present earnings. When that rate rises to 5%, which is where we are, the arithmetic changes significantly. A company trading at 60 times earnings in a 5% rate environment requires a very specific, very optimistic set of assumptions about the future to be rational. Moment those assumptions wobble, the math becomes very uncomfortable, very fast. Force 3, geopolitical and supply chain fragility. In 2000, we had what economists called the peace dividend: relative stability, expanding global trade, predictable supply chains. In 2026, we have the opposite: energy price volatility, supply chain nationalism, defense budgets competing with domestic investment across every developed economy. Force 4, the liquidity transition. For much of the past 2 years, markets have been pricing in a return to cheap money. The expectation of central bank rate cuts has functioned as a hidden subsidy to growth assets. That subsidy is becoming less reliable. I will not speculate on the precise trajectory of Federal Reserve policy, The current leadership transition adds genuine uncertainty to that question, and anyone who tells you they know exactly what happens next is either lying or deluded. What I will say with confidence is this: any investment that requires a return to near zero rates as a precondition for success is not an investment thesis. It is a bet on central bank behavior. And I don't make bets on central bank behavior. Nobody can predict it reliably, not even central bankers. When these four forces converge, debt-constraining policy flexibility, elevated rates challenging growth valuations, geopolitical pressure raising input costs, and liquidity expectations eroding, that is the Lollapalooza. And the Lollapalooza does not announce itself in advance. I want to add one more element here that the macroeconomic textbooks don't capture well: confidence. In late 2025, one of the more prominent AI infrastructure companies, a well-capitalized, well-regarded name, disclosed that its primary enterprise clients were using its platform primarily for internal productivity tools, summarizing meeting notes, generating first drafts of documents. The use cases were real, the productivity gains were real, but they were nowhere near sufficient to justify the capital structure that had been built to support them. Within 18 months of its Series D, the company had burned through $3.8 billion in capital. It was recapitalized at a valuation roughly 70% below its peak. Its investors, several of the most respected names in venture capital, took the loss without comment. Nobody went to jail. Nobody was lying. The technology worked exactly as advertised. The business model simply could not support the valuation. This is what I mean when I say the physics of reality. Physics doesn't care about your deck. But here's what I haven't told you yet. The biggest risk in the AI trade isn't the debt or the rates. It's something much more personal. It's why you bought in the first place. That's next. I want to pause the arithmetic for a moment and talk about something more fundamental. I have said for many years that the world is not primarily driven by greed. It is driven by envy. Greed, at least, produces a kind of energy. Greed wants more. Envy simply cannot tolerate the fact that someone else has what you do not. Envy is the only one of the 7 deadly sins where you cannot derive any pleasure. There is all the pain and none of the fun. It is a particularly stupid vice. But here is the problem. In markets, envy masquerades as rational analysis. In 2024 and 2025, you watch something happen. People, neighbors, colleagues, perhaps people who had never shown any particular financial sophistication, made significant money on AI, themed investments, an ETF here, a few shares of a chip company there, and something happened to your discipline. You felt foolish. You questioned your judgment. You thought, maybe I am the one who is missing something. Maybe the old rules do not apply anymore. Maybe this time really is different. So you bought in, not because you had done the arithmetic I just walked through, but because watching someone else profit while you sat on the sidelines had become psychologically unbearable. This is the man with a hammer syndrome. When every conversation, every earnings call, every financial media headline is saturated with a single word: AI. Your brain begins to match. Every investment starts to look like an AI opportunity. You stop asking, is this a good business? And you start asking, does this have an AI component? Now, I want to say something that the purely bearish analysis almost always omits, because it requires intellectual honesty to admit the smart money is not entirely wrong. The people at the major venture funds are not idiots. The investors who identified the AI infrastructure trade early and positioned correctly made genuine, rational return. They saw a technological transition. They acted on it before the crowd arrived, and the underlying technology may indeed prove to be as transformative as the optimists claim. I believe it will. The bull case is not crazy. I want to say that clearly. The bull case is not crazy. The problem is not the technology. The problem is the price. Here is the distinction that separates investors who build wealth from investors who participate in wealth transfer. Amazon in 2002 was a great business at a very cheap price. Nvidia in early 2025 was a great business at a very expensive price. Same equality of company, completely different risk profile. Paying $1.20 for something worth $1 in the hope that someone else will later pay $1.50 is not investing. That is speculation. And speculation is only profitable up until. Here is a test I want you to apply right now before we continue. If the AI narrative disappeared from the financial press tomorrow completely, no more earnings calls mentioning it, no more magazine covers, no more neighborhood conversations about it, would you still want to own this company? At this price, if the answer is no, you own a narrative, and narratives eventually have to be paid for with earnings. So if most AI companies are narrative, not investment, what does a real investment look like? The answer involves toll booths, and it is more important than almost anything else I'll say today. I want to make a distinction that most financial commentary glosses over, because it sounds obvious but is constantly forgotten in the heat of a market cycle. The distinction is between a great invention and a great business. These are not the same thing. They are not even closely related. The airplane was one of the greatest inventions in human history. It moved people and goods with a speed that would have seemed impossible to previous generations. For most of the 20th century, the airline industry as a whole lost money. Why? Because it had no moat. Any airline seat from New York to Los Angeles was functionally identical to any competitor's seat. Customers bought on price, and the capital intensity, the aircraft, the maintenance, the fuel, the gate rights, never allowed for the kind of margins that produce durable shareholder value. Warren Buffett once said that investors as a class would have been better served if someone had shot down Orville Wright at Kitty Hawk. He was joking. Mostly great invention. Terrible business for shareholders. For 100 years. Now apply this to AI. Language models are becoming a commodity faster than most people in Silicon Valley are willing to admit publicly. There are now multiple genuinely capable large language models available at minimal marginal cost. Open source versions, competing proprietary versions from multiple well-funded companies. The performance gap between the very best models and the widely available alternatives is narrowing at a pace that fundamentally undermines the pricing power of any single provider. When every company has access to a roughly equivalent AI assistant, no single company has a competitive advantage from AI. The advantage has been democratized. The value migrates from the technology providers to the businesses and individuals who use the technology most effectively. The consumer is better off. The shareholder is paying for a commodity. This is not speculation. This is how technology commoditization has worked in every previous cycle without exception. Personal computing was transformative. PC hardware became a low-margin commodity. The spreadsheet was transformative. Spreadsheet software became essentially free. Bandwidth was transformative. Internet access became a utility people resent paying for. In each case, the value did not disappear. It migrated. So what am I looking for instead? I am looking for what I call toll bridges. A toll bridge is a business that owns a piece of irreplaceable real estate in the economy, where the traffic must pass through, where there is no viable bypass, and where the owner can charge a predictable recurring toll without meaningful capital reinvestment. See's Candies was a toll bridge. People who wanted a box of quality chocolates as a gift in California passed through See's. There was no adequate substitute. We could raise prices every year, and the customers kept coming. B&S Railway is a toll bridge. If you need to move freight across the American heartland by rail, you use our tracks. There is no practical alternative. Coca-Cola, at its core, is a toll bridge. The formula, the global distribution, the brand recognition, built over more than a century. Replicating that from scratch is not economically rational for any competitor. These businesses share a property. Their competitive position does not depend on being the most technologically current thing in the market. It depends on owning something that cannot easily be replicated. Now, which AI companies pass the toll bridge test. The semiconductor equipment manufacturers come closest because the physical and intellectual barriers to advanced chip manufacturing are genuinely high. But even there, the geopolitics of semiconductor supply chains are introducing new variables that complicate the story. The model providers are not toll bridges, they are in a race to the bottom on price, in a business where their most expensive input, human-generated training data, is becoming simultaneously more regulated and more contested. The enterprise software companies that are deeply embedded in business workflows, where switching cost is high and AI enhancement is layered on top of genuine operational dependency. Those may be toll bridges, but you have to do that analysis company by company, workflow by workflow. You cannot make a blanket bet on AI and expect toll. Most of the companies currently labeled as AI investments will turn out to be airlines. Important, useful, necessary, and chronically disappointing to their shareholders. And here is what makes 2026 different from every previous bubble cycle. The monetary environment that allowed all of this to happen is itself under structural pressure. The easy money that inflated these valuations is not coming back on the schedule that the market is priced for. That is the chapter that no one is writing about. Until now. I told you earlier that I do not make bets on central bank behavior. That is still true. But I do pay attention to the structural conditions that have historically enabled certain kinds of asset pricing, and what happens when those conditions are removed. For 15 years, from roughly 2008 to 2022, the global investment environment operated under what I would call the easy money assumption. The assumption was money will remain cheap, rates will stay low, the central banks of the developed world will provide a floor under asset prices. Whenever things become uncomfortable, there is a put option on the market, and it will always be exercised. This assumption did not just make investing easier. It fundamentally altered the mathematics of valuation in ways that most participants did not consciously acknowledge. When the risk-free rate is near zero, $1 of earnings 10 years from now is worth almost as when the risk-free rate is 5%. That future dollar is worth meaningfully less. This is not opinion. This is arithmetic. The discount is real. For over a decade, investors were rewarded for acting as if future earnings were nearly equivalent to present ones. Growth companies, companies with distant cash flows and near-term losses, benefited enormously. Not because their businesses improved, but because the mathematical environment they were valued in became more favorable. That environment has changed, and the important point, the one most commentary misses, is that the change is structural. $37 trillion in federal debt means the United States government is itself a large, ongoing competitor for capital in the bond market. Every year, trillions of dollars in maturing debt must be rolled over at current interest rates. This exerts upward pressure on yields that cannot simply be resolved by a policy meeting. And inflation, once it becomes embedded in expectations, is stubborn. The 2022 inflation episode changed what consumers and businesses anticipate. Restoring credibility requires sustained discipline, not a quarter of it, not a year of it. Now, let me be precise about the current situation. The Federal Reserve is navigating a genuine leadership transition in 2026, with meaningful uncertainty about the trajectory of monetary policy going forward. Markets are watching closely. What I can say, and what I believe to be true regardless of who chairs the Federal Reserve, is this: a central bank managing a $37 trillion debt load in an environment of geopolitical uncertainty and still elevated inflation expectations does not have the same freedom of action that it had in 20. The doctor who administered the painkillers for 15 years is now dealing with a patient who has built up a tolerance. The dosage required to produce the same market effect keeps increasing. And at some point, the medicine starts producing side effects that are worse than the original ailment. A is central bank that genuinely wants to protect the long-term credibility of the dollar, which is the foundation of American economic power, cannot simply print its way back to the 2015 playbook. The constraints are real. Here is what history teaches about liquidity-driven markets. When the marginal source of capital that has been sustaining an asset class begins to decelerate, the first things to break are the weakest links. In the current AI complex, the weakest links are companies that have consumed capital aggressively on the promise of future monetization, without demonstrating a credible path to profitability at current capital costs. These are not all obscure startups. Some are well-known names with enthusiastic retail followings. The second things to break are the infrastructure suppliers whose demand is entirely dependent on the build phase continuing at its current pace. Not because demand disappears, but because even a meaningful deceleration can produce a violent re-rating when the stock was priced for indefinite acceleration. This is not a prediction of a specific date or a specific percentage decline. It is an observation about the structure of the risk. And my observation is, the risk is asymmetrically to the downside in ways that current prices do not reflect. When the market prices in the best case and the world delivers the average case, the adjustment is rarely gentle. Now, I've spent 40 minutes diagnosing the problem. The final 2 chapters are about survival, specifically 3 filters that will tell you, quickly, honestly, whether what you own is an investment or a lottery ticket. Don't skip this part. Everything I've said so far has been diagnosis. Now, I want to give you the prescription. Not as a financial advisor. I am not your financial advisor, and you should not treat anything I say as personal investment advice, as a thinking framework, one that I have used for decades, one that any rational person can apply. 3 filters. I want you to run every AI-related position you own or are considering through all 3 of them, not just the ones you are uncertain about, all of them. Filter 1. I call it the subtraction test. The question is simple. If you completely remove the AI component of this company's business, if the AI narrative, the AI revenue line, and the AI growth assumptions all went to 0 tomorrow, what would you be left with? Would you be left with a viable, cash-generating business, with customers who would continue paying for a core product that exists independent of the AI story? Or would you be left with a company that is, at its core, a bet on AI adoption, with no meaningful business underneath the narrative? Microsoft passes this test. Remove all AI ambitions entirely, and you still have the dominant enterprise software platform, significant cloud infrastructure, LinkedIn, and a games division. The AI layer is built on top of a real business. Many of the smaller AI native companies do not pass. They are, in their current form, the narrative. There is no meaningful business underneath it yet. Passing the subtraction test does not mean an investment is good at any price. It means the underlying business deserves to be in the conversation. Filter 2, the Lollapalooza check. The Lollapalooza effect, as I described it in Chapter 4, works in both directions, downside and upside. For your investment to be genuinely resilient, to survive a period of AI hype deflation, it needs what I would call overdetermined competitive advantage. Not one reason to win, 3 independent reasons. Minimum. The question for this filter is, if you remove the AI tailwind entirely, does this company still have 2 or 3 independent, durable reasons to retain its market position? I am looking for businesses where the competitive position is built in layers. See's Candies had brand loyalty, regional emotional attachment, and a distribution infrastructure that had been built over decades. Any single one of those advantages alone would have been insufficient. Together, they created a position that was very difficult to attack. Coca-Cola has the formula, the global distribution network, and one of the most valuable brands in human history. 3 layers. Most AI companies right now have one layer. They are currently the best at something that is changing rapidly. Single-layer competitive advantages do not survive commodity transitions. The companies that will emerge from the reset as genuine compounders are the ones where the competitive position was already strong before AI, and AI has merely extended it. Filter 3. The inversion test. This one comes from my most fundamental analytical habit. When evaluating almost any important decision, not what could theoretically go wrong in an extreme scenario. What plausible, realistic things would need to happen for this investment to fail? If this investment fails when the Fed keeps rates higher for longer, you own a bet on monetary policy, not a business. If it fails when a competitor releases a better model, you own a bet on technology leadership in a race that has no finish line, not a durable position. If it fails when enterprise clients slow their AI adoption budgets and 90% of the revenue disappears, you own a company with no margin of safety. Benjamin Graham described margin of safety as the three most important words in investing. You pay 60 cents for something worth $1. Even if you are wrong about the dollar, you are protected. Most AI investments at current prices offer the opposite of margin of safety. You are paying $1.20 for something that might be worth $1 if everything goes right for the next 10 years. I do not play that game. I have never played that game. The results of that game are always the same. Occasionally spectacular gains, followed by a catastrophic correction that erases the gains and more. Run these three filters. Be completely honest about what survives. The companies that pass all three: real business underneath the story, multiple independent competitive layers, genuine margin of safety, those are worth owning. The rest, let someone else hold the bag. They will find someone. I promise, one chapter left, and it is the most important one. I want to close with something unpopular. The greatest edge available to an investor is not intelligence. It is not access to information. It is not quantitative sophistication. It is patience. And I mean something specific by patience. I mean the willingness to hold cash or hold boring businesses or hold nothing at all for months, sometimes for years, while waiting for the moment when a genuinely great business becomes available at a price that offers real margin of safety. Most professional investors cannot exercise this kind of patience. They have quarterly mandates. They have clients asking why they underperformed the benchmark last quarter. They have career risk attached to not owning the thing that everyone is talking about. This structural constraint is not a flaw in the system. It is the source of the opportunity for anyone who operates outside of it. When the AI repricing comes, and I believe it will come, I simply cannot tell you when. There will be a period where extraordinary businesses are available at ordinary prices. That is always how it works. The fear that follows a bubble is as irrational as the optimism that preceded it. Both create opportunities. In the fear phase, the patient investor who preserved capital while others were speculating will be in a position to act decisively. I have been through this cycle several times. I was there in 1973 when great businesses were available at fractions of their intrinsic value. I was there in the early 2000s after the internet collapse when genuine companies with real businesses were being sold at prices that defied logic purely because they had a .com association. I was there in 2009 when fear was so pervasive that people were selling things they would never rationally sell, simply because they needed to see something go up in their account. In each case, the opportunity was available to anyone willing to do two things: not chase the preceding bubble, and act decisively when the fear was greatest. I cannot promise you the AI repricing happens in a particular quarter. I cannot tell you how far the overshoot reverses. Anyone who claims they can is either lying or selling something. What I can tell you is that the arithmetic is what it is. The debt is what it is. The ROI gap is what it is. And history, however, imperfectly, rhymes. Here is the question I want to leave you with, not as a rhetorical device, as a genuine analytical exercise that I would encourage you to sit with. If you had to place 100% of your investable net worth into a single company, and you had to leave it there for 10 years without looking at the stock price, which company would you choose? Think about that carefully. The answer reveals something important about what you actually believe, as distinct from what narrative you've been participating in. If the answer is an AI infrastructure company at its current valuation, I would gently ask you to run it through the 3 filters I described. If the answer is something entirely different, something boring, predictable, and fundamentally cash generative, then you already understand the lesson. Great technology does not automatically produce great investment returns. Capital discipline, patience, and the refusal to pay too much for even the most exciting story in the room. These are the edges that compound over decades. I have never been in a hurry to be right. I have only ever been in a hurry to be rational. Stay rational, stay patient, and for goodness sake, stop letting other people's excitement do your arithmetic for you.